Hey everybody, thanks for checking in ahead of the long weekend. Lot to talk about today. We'll do it pretty quickly though, related to the Fed, Kevin Warsh, who came in a little bit more hawkish than I think just about anybody was expecting. Especially that focus on price stability, and I shouldn't just say focus, focusing over and over again on that, and what the implications are for equity markets, market internals. And we'll have some ideo things to talk about. But before we get there, I do want to get to showing off the interns for 22V dominating the parade today. So here we are with some photos. We got the hats, we got the shirts, and I got a lot of them here. So if anybody wants one, please let us know. That's a reward for actually watching this video on a Friday before a long weekend. Here are the interns, doing some wonderful marketing for us down at the parade. Here's a better look at the shirts if you want them. Now, 3 of the people in this photo are interns. 2 are not, and it happens to be the people in the Brunson jerseys. I do not know who these people are or why they're in this, but I'll follow up with the interns on that later. Michael on the right clearly is very excited to be in this photo. So thanks for doing that, Michael, for tolerating it. But anyway, that's what the front of the shirts look like if you want one. And here they are with the hats and the shirts on the subway, pretending to read some research, it looks like, or actually reading it. I don't know. I shouldn't be so dismissive. But hey, it's our day over here at 22V. Next parade day, we will stop our grotesque focus on the Knicks and the winning. And we'll go back to normal programming in the future. I can't promise it totally, but if you want a shirt, want a hat, let us know. Coming your way. All right, on to the Fed, the charts, etc. All right, so a couple of things. Getting questions of why the market's actually bouncing today, given how much more hawkish the FOMC statement and press conference and forecast for inflation, unemployment, etc. was than expected. It's something important to keep in mind that the Fed is on hold still. And as long as the Fed is on hold, and I've bolded this up here, the economic expansion will continue. Earnings expectations should not change much. They're continuing to be biased higher. We do have margin tailwinds as related to AI. That's the good news, right? There's no real tightening of financial conditions that should be expected relative to base case. That being said, and the reason why it's very difficult to chase the market higher, given the FOMC meeting yesterday, is because a tightening campaign is no longer a tail risk. It's basically a clear and present danger. And a tightening campaign would come along with much higher recession probabilities and significant downside risk to equities. So we think it's more of like a violently flat backdrop for now. Wrote about that today. A little bit more confident on the internals, which is the early cyclicals, and I'll come back to that in a bit. But just to give you some context and looking at the chart, when you think about the tightening of financial conditions, the line in the sand that seems to have been outlined, the Fed in the statement revised its core inflation forecast sharply higher to 3.3% in 2026 from 2.7%, and they're at 2.5% for next year. All right, now to reach that 3.3% projection, core PCE needs to print roughly 21 basis points per month from June forward. All right, so that's the bar. And if you take Warsh at his word on price stability and the focus on price stability, and the fact that it was mentioned 2 times in the statement, if core inflation is tracking above 21 bips on a monthly basis, that would not be consistent with price stability. And the odds that a tightening cycle commences would increase meaningfully, and that blue line here, which is the current representation of financial conditions, would move up significantly. So on this chart, the orange line, and I've shown this many times, is core PCE, and then there's a simulation that if you printed 0.3 a month, right, and that would just show core inflation accelerating away from you. So anything above 0.21, and the closer you get to 0.3, of course, would come along with significantly higher risk of tightening financial conditions, that blue line shooting much higher. It doesn't have to happen yet. I mean, the market has probably internalized the Fed's reaction function. 2-year yields are reflected in this, roughly speaking, financial conditions index. So If things just stay as they are, it's fine. But the reason they would stay as they are is because you hit that 21 basis points a month or below on core PCE. And to do that, which is something we've been reinforcing over and over again, you do need consumer spending growth to slow. That's important. A little bit scary, just from a technical point of view, is that John Roque sees that 2-year yields have upside risk to 5%. That's his target. I'll put this in technical terms. To the extent that were actually come to fruition, a 5% 2-year yield, that would be a major headwind for risk assets. The technical term being it would be bad. So it's not something you actually want to see. And you wouldn't see a 2-year yield heading towards that 5% target is if over the next couple of months you were around that 21 basis points and hopefully below on core PCE, and you saw some slowing in consumer spending. That would be really important. On the next chart, gets to what I didn't mention as a reason for a 2-year yield to move lower: oil prices. And I fielded a lot of questions on this yesterday, whether or not the decline in oil prices, the memorandum of understanding with Iran, etc., means that we're at peak hawkishness now. The answer is absolutely not. One way to represent that is the chart on the left. The blue line is the current 2-year yield. The orange line is oil prices. You see the decoupling recently, and this is basically just a year-to-date chart, but the decoupling over the last month between 2-year yields and oil prices. So they were tracking very closely together, but they have since decoupled. So it does seem to me that the market or investors have internalized the fact that core inflation, which has a little bit of influence from oil prices, but not much, is the main issue. So oil prices coming down is not just a kick save. You actually need core inflation, and more specifically, core services inflation to come down. And as it stands today, just doing the bean count, core services inflation is about 70 basis points too high. And core services inflation is going to be driven more by consumer spending, the tightness potentially in the labor market related to the service sector, which right now is not the case but could become later. Or just the strength in consumer spending in general and how that bleeds into services, because the U.S. economy is largely services. The good news, to some extent, is that the market or investors are pricing a little bit of a slowdown in economic growth, and I would call it a benign slowdown. So on the right-hand chart, what you can see is that the yield curve has flattened. The 2-year through 10-year yield curve has flattened meaningfully, suggesting that the current level of 2-year yields and the current level of financial conditions in aggregate should be associated with some slowing in economic growth. And for now, it appears like it'll be a benign slowdown. And the reason we can have confidence in that is because despite the fact that the yield curve has flattened some, again, discounting some slowing in economic growth and by extension inflation into the future, we know that credit spreads are tight. We know that stock prices are not going down. You're still relatively full valuations. And that wouldn't be happening if the yield curve was indicating much higher recession probabilities. And a benign slowdown is not bad for risk assets. What we need to avoid is a tightening cycle to slow growth even more. And that would happen if inflation stays stubbornly above that 21 basis points a month, and that would happen if core service spending and core service inflation or real spending growth stayed at the current levels. They need to slow, bottom line. As it relates to early cyclicals, because we continue to get questions on this, lower oil prices and lower 10-year yields related to a benign slowing in inflation and GDP growth are structural positives for early cyclicals, defined as tech, discretionary, communications, and yes, eventually banks do benefit, and home builders, which today are benefiting. We understand the knee-jerk reaction yesterday to those names moving lower. It was a hawkish surprise. Growth outlook, as a result, has to come down. But over time, you have to remember that growth decelerating from 3%, which is well above trend, to 2%, which would be associated with little inflation or much less core inflation risk, or a benign slowdown, if you will, paired with falling oil, lower yields, and eventually softer inflation, is a constructive backdrop for duration-sensitive cyclicals, which are your early cyclicals. All right, so on the left-hand chart, what we're showing you is the S&P sector groups and which are the most duration-sensitive. Technology and discretionary are two of the top three. On the right-hand chart, we're showing you early cyclicals versus deep cyclicals relative performance. A little bit of a consolidation here on an equally weighted basis and a cap weighted basis recently. They came under intense pressure. So early cyclicals really struggled. Again, your tech, discretionary, communications relative to deep cyclicals, which are energy, industrials, and materials. At the onset of the war, it was a really bad backdrop for those names. They came back meaningfully as consumer spending held up in the face of the energy shock. Consolidated some, but are bouncing back right now. And again, a benign slowing in economic growth, lower oil prices, lower 10-year yields is good for the early cyclicals, and it's bad for the deeper cyclicals. Hence, I'm showing you this chart. So our call is that orange and blue line are going to keep going up and to the right, which would mean early cyclicals, tech, discretionary, and communications, outperforming deeper cyclicals, energy, industrials, and materials. Now, we have to make an important nuance here. When we talk about the deep cyclicals being a little bit of a laggard, we're very specific to those that are not benefiting from the AI capex build out. So your cap good names, or your industrial names, or your material names that are benefiting directly from the AI spend, which will continue as long as recession probabilities are low. Again, our call, those names will still benefit. We're really more focused on the commodity names, the materials names, the industrial names. We can send you the list of names, by the way, that fit this bill that are not, at least reporting their own commentary, benefiting from AI. All right, so it's commodity cyclicals that are not benefiting from AI, and presumably these were the inflation hedges against the Straits of Hormuz tail risk, which now seems to be much lower, and the Fed is much more focused on price stability, which means lower inflation, which doesn't help an inflation hedge. So that is, I think, a fairly compelling reason why you want to own early over deep cyclicals. Playing out today, we'll see if that continues. It's just tricky from a market point of view because I think it's tough to be chasing the markets at these highs. So it's more of a relative call than an absolute call. Moving on to the next chart, just a couple of idio points that benefit from lower oil prices. Reiterating long domestic Brazil, because I think it's interesting. We did a webinar, which I can send you that if you want, with a Brazilian hedge fund manager who's an expert in the area. We want to own small cap and or domestic focused Brazilian names. These are names that would benefit from lower oil prices, that would benefit for the election getting behind us in Brazil. The black line represents those names relative to the S&P 500. So you think about the Brazil ETF, a lot of it is related to PBR, which is a giant oil name. So you want to be long Brazil, the domestic names X that, so something to take a look at. And an area to fade. What's interesting is how little Hong Kong, as an example, market has bounced. So Michael Herson and Ho Tse-Song at 22V Research, who are our China macro and policy experts here, Michael Herson runs the group, do believe that oil prices will not be a trigger for rebound in China's domestic consumption. A lot of the data we've seen coming out of China, especially from a domestic consumption point of view, has been very disappointing. And there's probably some hope that you get a bounce here as oil prices come down. That being said, we've seen nothing out of Hong Kong, and the Hong Kong index is more levered to domestic Chinese demand and Chinese financials. So where Shenzhen is levered to AI-driven exports. So there's a little bit of a differentiation there. So we want to focus much more in on the Hong Kong demand names. So that's where we think you should focus in on. So that's it for today. Certainly a relatively shocking hawkish commentary from Warsh, but it's not over in the sense that the market has to, move significantly lower. It's not obvious that financial conditions need to tighten right away. That risk has to be pulled forward relative to what we previously thought. So we've done that. But if the inflation data cooperates, which is to say 21 basis points or below on a monthly basis, and the economic growth slows as we expect in the back half of the year, and that's mostly going to be consumption driven, as we have some slowing in labor market growth after the bounce back we've seen, and the fiscal impulse starts to fade from tax refunds. So as that happens, you should see much less pressure on core inflation on a go-forward basis. Plus, you're running into the more positive tariff comps for inflation. If we're wrong on that, tightening cycle becomes much more obvious, and then you have a much more meaningful downside risk to the market and all things speculative assets, because financial conditions would need to tighten more significantly. Thanks for listening. Have a great long weekend. Let me know if you want shirts. Let me know if you want hats. Thanks to our interns for doing the heavy lifting on going to the parade, and because I'm sure that was just one of the hardest things they could have done all summer. And have a great weekend.